The accounts of a government are referred to as the fiscal accounts. What is the fiscal balance and why is it so important? Let us look at the different categories of expenditure and then of revenue, and then we talk about the fiscal accounts. A government's expenditure can be disaggregated into expenditure on programs, the cost of general administration, interest on the public debt, and those together make up recurrent expenditure, and then capital expenditure, which is the government expenditure on building up the country's capital stock. We're talking about building roads, expanding ports, and installing water pipes. If you look through the accounts of a government, you're also going to see other categories of payments. You're going to see amortization. Amortization is the paying off of the principal of outstanding debt. This is not counted as a category of expenditure. And the reason for that is that whatever the debt was acquired for, whatever the money was borrowed to pay for, that expenditure was already counted in the year it was spent. To count it as expenditure again in the year that the debt is paid off would be essentially counting the same expenditure twice. Similarly, any revenue, any funds that are not spent but simply transmitted into a savings instrument, used, for example, to buy assets or securities, is not counted as expenditure. Those are just forms of saving. So when you go through a country's fiscal accounts, you omit amortization, you omit the purchase of financial securities, and you count as expenditure only programs, general administrative expenses, interest payments, and capital expenditure. On the taxation side, we categorize taxes by what is the product or asset or activity that is being taxed. So taxes can be levied on income, taxes can be levied on assets, on production and consumption activities, and on international trade. Taxes on income, income taxes, and on assets are together called direct taxes. Direct taxes are called that because those are deemed to be taxes on the actual entity, on the person or the business. Whereas taxes on production, consumption, or trade are called indirect taxes. The entity is being taxed by way of its activities. Different countries collect their taxes in different ways. The shares of each type of tax that make up each country's total revenue is quite varied. We see here, for example, that in India, for the federal government, income taxes make up nearly half of their tax revenue total. The fiscal accounts, like all accounts, is a representation and categorization of inflows and outflows. Expenditure on one side and revenue on the other side. If the two amounts are roughly equal, we say there is a fiscal balance. If, however, there is insufficient revenue to pay for all of expenditure, then the government is running a fiscal deficit, and deficits have to be financed. The funding to pay for the extra expenditure has to be found. There are two possibilities. One is debt financing. The government can borrow the money to be able to pay for the extra expenditure. It can borrow it from the local capital market. It can borrow it from the international capital market, or it can borrow it from multilateral lending agencies like the IMF and the World Bank. Financing in this way means that the government is accumulating debt that is going to incur interest payments in future budgets. A second possibility is to create new money in order to pay for the extra expenditure. New money creation runs the risk of there being more money in the economy than is warranted by the actual volume of transactions taking place, and that ultimately leads to inflation. So each of the two ways of financing a fiscal deficit comes with their disadvantages. The opposite case of a fiscal deficit is where there is more revenue than the government spends on its programs and administration and interest and capital expenditure. This is the case of a fiscal surplus. The extra funds that it has that make up the fiscal surplus have to be disposed of. And again, there are two possibilities. If there is debt, the money can be used to amortize debt, to pay off the principal on outstanding debt. A second possibility is that it can be saved. It can be used to purchase investment instruments. It can be used to put into a government's sovereign wealth fund for investment. So those are the two options. Whether there is a fiscal surplus or balance or a deficit is important. And it's important because this static outcome, this outcome for the current period, has dynamic implications, has implications for the future of the economy. The amount of investment, the amount of private investment that takes place in an economy is determined in the market for investable funds, the credit market. That is where investors come to finance the investments that they want to make, and where savers, domestic savers, foreign savers who want to earn something in the local economy, and the government come to be able to put their savings. It is the outcome of the interaction in the credit market that determines the rate of interest and the amount of investment that takes place. If the government runs a fiscal deficit, then borrowing from the local capital market means it is taking funds away from what would otherwise be available for private investment. It is crowding out private investment. And so therefore, we're going to have higher rates of interest and less private investment taking place. In the opposite case, if the government runs a fiscal surplus, then it is adding to the pool of savings available for investors to borrow. And so the country will have a lower average rate of interest and a greater volume of investment. The amount of investment that takes place determines whether the country will have a smaller capital stock in the future or a larger capital stock in the future. The larger the capital stock, the greater will be the level of output in the future, and therefore the higher will be the country's standard of living. So the decision in any particular fiscal year to run a deficit, a balanced budget, or a surplus has important implications for the future of the economy. Our takeaway is that the fiscal balance has long-run consequences for economic growth.